Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
It has been far too long. Alicia Levine of BNY brings an absolutely prodigious mathematical, almost cross-mathematical skill into investment analysis. We go Euclidean with her right now. Ben Laidler's talking about third year, could we go up 20% again? Can you be that bullish about 3 years of big double-digit growth?
So in theory, I could be, but in our 2025 outlook, we're up about 10% for next year, simply because it is the third year after the bottoming of the bear market. And typically in that third year, you just don't have those huge gains that you see in the first year out from
Is it a
low.
multiple expansion or the earnings
So
pick up
it's
to help
earnings.
out?
So we're at, as you know, we're at 22 times forward earnings. So we're looking for earnings to really carry, because the multiple was up about 3 times in the last year. There was, okay earnings growth, about 8%, and the rest was the multiple. So you need earnings now to really kick it. And that's what we see. And you're not going to be up 20% in earnings.
I'm sorry, I'm coughing. I choked on my tang, excuse me.
Exactly. Alicia, we haven't had a pullback, and I can't remember how long. I mean, I guess you go back to July, and it was 8 or 9%, but
right. in 2 days.
Yes, exactly. That's not healthy for a longer-term bull market, is it?
So the average drawdown, even in years where you're up 20%, is actually about 12%. Okay, so this year the most we got was about 8%. So it's very easy, steady year of gains. I think next year you're going to see more volatility. We do think the year ends higher. We're at 6,600 for the end of the year. But I just want to take everybody to the Wayback Machine and think about the late 90s when the Fed cut into a soft landing, when there was no recession. We had 5 years in a row of 20% plus growth. Okay, so if we're really thinking about it, our view is we're not heading towards a recession. The Fed this year alone is cutting 100 basis points. Even if they can't cut as much as they projected back in September, we think with the inflation picture they're not going to be able to. The growth picture is better than expected. You could see a third year of really nice returns in the S&P. There's historical precedent for it. We just think it's more volatile with different policies coming through with the new administration.
Did you guys change your outlook for investing in 2025 given what we saw in the elections just last month? So
we've been bullish for about almost 20 to 22 months here. We took back.
I thought you were going to say 5 years, but continue.
Well, we like everybody else, given history, thought when the Fed's cutting this quickly, they're bound to break something. But really, it was the Silicon Valley, the saving of the depositors from the Silicon Valley crisis and the standing up of all those lending facilities at the Fed that sort of stopped the financial crisis that would lead to a recession. So after that, we got bullish. We've been positioned overweight, U.S. large cap for a long time.
Right. And you still are?
We still are, and we, 2 years ago we we went to a large underweight on international and emerging markets, and we've kept that because we think in a world where the Fed can't cut as much.
Stop it! You're not playing fair rules. You've got Jeffrey Yu. I mean, that's all that's all you got to know. You don't have to think about this. Jeff, what do we think? Thumb up or thumb down? That's the real world.
And we speak all the time.
You're too young to remember this, but the late 90s, folks, there was a modest technology overlay. Sweeney and I woke up in March of 2000 or 2001 and said, oh, there's no profit. What a shock. We have the same technology overlay right now, but we've got profit with it. Is that the theory?
The theory is the profit is better. Let's go back to the late 90s. Starting in the late 90s, you saw a steady increase in the operating margins of the S&P, which created a higher multiple regime for the S&P. If you just go back in time and you get your average of 16 times forward earnings, well, your margins were also 9 and 10%. Now we're looking at 13.5% for next year, and that's because it's being driven by the cash flow of tech. And so the companies are healthier. It's not just earnings, it's free cash flow margins are better. It's keeping the multiples higher. You've got a healthier market. And the pricing of tech compared to the rest of the market on a relative basis is actually lower than it was in 2021, 1999, and other periods where there was a tech boom or a technology change where the market got excited about a technology change. So it's relatively less expensive given free cash flow margins and earnings.
Alicia, are you concerned about the lack of breadth in the market? S&P, SPX versus SPW, the equal weight, a real divergence there, which has actually widened out a little bit here in the last few months. Someone with your experience, does that concern you?
Look, it's a risk. It's a risk because then you need those top 10 companies to keep on performing. I also think, and we've talked about it in the context of, well, why do you still like U.S. large cap? There's a lot of talk about, overweighting small cap because of the Fed cutting and a boom of cutting regulations. That's all true. There's sort of a safety trade, and we've really seen this in the performance of NASDAQ versus the Dow. Over the last, let's call it 10 days, the Dow's down 3%, NASDAQ's up 3%. These stocks are safety stocks because they have so much earnings.
Okay, this came up at the dining room table over a beverage of my choice. Is Apple a utility? Now, it's not Dominion Electric from a few years ago or even Con Ed, but does Apple have utility characteristics in terms of persistency of cash flow?
Yes, and they pretty much, like the tops, the Magnificent
They have an inertial
Seven,
force.
They have an inertial force. It's the safety play. Look, when rates get to 4.5% and 5%, what are you buying? You're buying large cap tech because it's relatively immune because they don't have to borrow to grow. And you see it. I mean, think of what happened yesterday. Small cap was terrible, and NASDAQ was down, but not that much. And that's what you're going to see in these rate fears that you're going to get because of rate volatility, the inflation reads, and the Fed statement today, for instance.
You got 10 seconds. Does BNY let you put an SPX target out?
Yeah, 6,600 end of 2025.
But is that going to go up here in the next 8 seconds so we can make some news?
Yes, it's good. Yes. I think the first quarter actually could be very good. There'll be a lot of liquidity in the market. So
You're going to be in New York the first quarter? Thought you'd wander by?
I'm going to be here all the time.
Living on airplanes. Alicia Levine, thank you so much. With BNY, just brilliant, her mathematical construction, the geometry of her construction of the market.
Chicago.
It's just, she got like 8 degrees in math. And, she took differential equations. She's spouting them at the dining room table with her kids. Mm-hmm. Her husband's looking at her going, would you shut up? I don't need Diffie Q at the dining room table.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
It is Fed Day, and we're not going to drown the moment in Fed chat with Jason Furman, professor of practice of economic policy at Harvard, teaching Ec 10 and great on policymaking as well. I can't say enough about his contribution to the zeitgeist over the last year or two with his ecumenical study of our inflation rate. It's the number one value add out there. I retweet it out always, and today we're going to do a conversation with the ecumenical Jason Furman. Jason, I was talking to Chairman Bernanke at one point, and we talked about hockey stick charts. Or Olivier Blanchard at AEA a number of years ago after a great financial crisis with a jump condition to lower growth and then the glide path back. Your language right now is that we're at a hinge moment in the American economic experiment. Discuss what that is. What's a hinge moment and why is it now?
Yeah, so it's great to be with you as always. The plane was coming in. It looked like it was landing, and it is still just sort of hovering above the landing strip. It's not that far away. All in, I think I'd be quite happy about where we are in the economy, but we're not making progress anymore towards the Fed's 2% goal. And so the question is, are we going to, cut inflation by a couple tenths? In which case everything is happy, soft landing, interest rate cuts, champagne, everything. Or do we go up a few tenths, in which case maybe the Fed has rate increases back on the table. And right now, what happens at 1600 Pennsylvania Avenue will have some effect on this as well.
That's kind of where I wanted to go, Jason. I wondered just kind of if your view of this U.S. economy, maybe even the world economy, did it change at all after the U.S. elections last month?
Look, like a lot of people and like the markets, I mostly was discounting President Trump on tariffs, thinking they were negotiating tactics, that yes, we're going to get more tariffs on China, but we're not going to get something broad-based on other countries. With each passing day, he's either a better and more credible negotiator than I realized, or actually believes what he's saying and is likely to follow through and do it. So I've gotten more nervous about the actual possibility of tariffs. I think some things like the Fed, he's been better about. Scott Bessent and Kevin Hassett were very reassuring as picks, but I think the big one is the tariffs, which he has a lot of ability to do all on his own.
Tariffs go into just, I guess, a broader conversation of internationalism. I mean, I kind of came up in this business where it was increasing globalization across the board. The world got a lot smaller, in large part thanks to technology. But boy, the last 6, 7, 8, 9 years, not just in the U.S. but around the world, it seems like nationalism is replacing internationalism. Is that something that is a plus or a minus, or how do you think about that?
Yeah, I mean, one remarkable thing, you're absolutely right in your diagnosis. But one interesting thing is for the last 10 years, wages have been growing more at the bottom and the middle than they have at the top. We've actually had a compression of wage inequality. We've had, pretty decent income growth over the last decade with some serious ups and downs, especially in the inflationary period. Productivity growth in the United States, at least, has actually picked up. So in a lot of ways, things are working. They're not working perfectly. They're never working perfectly, but they're working pretty well, which makes the turn away from globalization and the timing of it, at least in the United States, somewhat surprising.
Jason, let's clear the air here. And I think it's really, really important. Paul's good question on, the future with the Trump administration. Kevin Hassett maybe is going to drive the economic boat for President Trump. We'll see on that. He's out of Penn with Alan Auerbach. You're out of Harvard with Greg Mankiw as well. On the Venn diagram of Hassett, Furman, Furman, Hassett, how much do you and Kevin Hassett agree upon in economics and policy?
We agree on an awful lot. I'd say the main place we disagree is taxes. He would like lower taxes, especially on corporations and capital. And I place more of an emphasis on productivity, and I'm more skeptical about some of the larger growth numbers that he would believe in, although I think taxes do matter for growth.
I can't emphasize enough, Paul, how this is misconstrued in the media. They want Hassett to be completely opposite of Furman. And it's just not the case. They got a substantial overlay around the things we discuss each day.
And Jason, it seems like...
look, recently I did a thing with him where he was defending the Fed's 50 basis point cut, and I was saying they should have done 25, back in September. So, sometimes the positions aren't even what you might predict.
And Jason, just, on the tax front here, it seems like that likely is going to be something that this administration is going to want to extend the 2017 tax cuts. How do you think that could play out, should play out, will play out?
Oh, look, I think they're going to extend them. The question is for how long. I think that's a real shame. There's a number of people that think you should use what's called the current law baseline, that you shouldn't add to the deficit as measured by CBO. If you extend those tax cuts, you're basically locking in deficits of at least 6% of GDP, probably 8, 9, or 10% of GDP over the coming years. And that's just not a place we should be now. In 2017, I didn't think we could afford the cost of the tax cuts. In 2025, it will be even less affordable given where the debt is, given where interest rates are.
Matt Winkler, our Emeritus Editor-in-Chief, Jason Furman, just did a summary of the facts of the Biden administration. And, it was very much pro-Biden. And, of course, you've got a Democratic Party shingle out as well. Is President Biden's legacy completely overwhelmed by the growth of the debt and the deficit?
I think that's a part of the legacy. And that, by the way, played into things like the higher interest rates we have now and higher mortgage rates, which, by the way, were probably part of what was going on in the election in November. There was a very strong economic recovery. That's on the plus side. I think we overdid it and got too much inflation. That's on the minus side. And the inflation, I think, is underappreciated, how it's eaten other parts of the legacy. For example, the cost of infrastructure has gone up more than spending on infrastructure. And so in real terms, it appears that we're investing less in many areas of infrastructure than we were before.
One final question. Are you the Grinch and you gave holiday reading, forced hundreds of pages of reading to Ec 10 at Harvard?
I gave them their final grades for the course and sent them away. There was listed some optional reading, but no one's going to ever check on that.
Okay, great inflation guy. Mankiw was brutal. He dealt out C's like they were French mints. Did you give out any C's, Professor Furman?
We did give some C's. We even gave some D's. I don't want to talk about anything below that, but we try to roughly match the average grade in comparable courses. I don't want to penalize people for taking economics compared to something else, because I think everyone should learn economics.
That's a whole story in itself, folks. Jason Furman, of course, and I can't say enough again about his work in describing inflation away from the blather with his ecumenical analysis of inflation. Professor Furman doles out C's at Harvard.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us right now, it has been way too long, in a different conversation. Jason Trennert is Chief Investment Strategist at Strategas. He's just been wonderful over the years of a belief in America, a belief in our capitalism, and you participate in the equity markets. Jason, for a part of this discussion, this conversation, I have to change the dialogue, and I'm going to blame it on one C. Gasparino over at the New York Post. Okay. Jason, are you under consideration, or are you in discussions with the Trump administration, with Mr. Lutnick, about serving the future president of the United States?
Well, I've been down to Palm Beach, and I've talked to the transition on a number of occasions, and to be honest with you, that's about all I know. But I'm very much willing to serve, given the right opportunity, and certainly I'm very supportive of the new administration. And so it would be an honor, if asked. But nothing has been asked yet. So we'll see how that goes. And for the record, by the way, you'll never see me wear Birkenstocks.
We knew that.
I'm more of a wingtip guy, but anyway.
I was on safe ground there. Mr. Gasparino goes on to say you would be, quote, a leveling force. What is the leveling force, Jason Trennert, that President Trump needs to hear from the Treasury Secretary and from a potential Trennert at 1600 Pennsylvania Avenue?
Yeah, and I'm sure if I were offered something, I wouldn't exactly be a heartbeat away, by the way. And I'm not sure President Trump needs any leveling force, because I'm very much in agreement with many, if not all, of his policies, particularly with regard to trade. And I also think certainly in terms of rationalizing the size of federal government. So in my opinion, I don't think any leveling force is needed, but I would be a strong defender of the policies that he's talked about.
All I know, Paul, is if Jason DeSena Trennert joins the Trump administration, you're going to hear President Trump talking about Italy is the 52nd state. Continue.
So, Jason, what would you advise the president as to economic policies in terms of a kind of a to-do list, or maybe a step 1, step 2, step 3 type of recommendations?
Well, listen, I think, again, and I don't want to be overly, I don't want to be presumptuous. The president has a great economics team there right now. But in my opinion, I do think President Trump was elected for two reasons, largely. One is I think that there's a sense that the immigration policies of this country have gotten out of control and have hurt just average Americans, and I think he's right about that. And I also think that inflation was another big issue. And as you know, we've created something called the Common Man CPI, which looks at things, it's the opposite of Supercore, which excludes food, energy, and housing, which, in my opinion, is all those things are pretty core. So we go the other way, and we just focus on things people have to buy. And I do think that certainly deficit reduction would be a good way to start to try to rationalize prices. It's hard to run deficits 6 to 7% of GDP continually and then expect to make real progress on inflation, in my opinion.
Right.
So I think he's got those things right for what that's worth for him, and that's in my opinion, that's very, very likely to be where he starts. And that's why he was elected.
Paul, this is important. What Mr. Trennert's doing with inflation, like the real inflation, harkens to Lawrence Kudlow. And this is something Larry Kudlow's really, really been right about, is this insistence to core. It's not the real world after all.
Yeah. So, Jason, to the extent that this incoming administration would like to reduce deficits from 6% of GDP to 3%, how do you do that? What's the way forward, do you think?
Well, listen, it's not, and I don't think, to be very realistic about it, I would greatly suggest that we don't try to throw the thing in reverse. President Trump didn't create deficits of 6 to 7% of GDP. I don't think he should be expected to reduce them to 3% in a year or 2 years, but he does have 4 years. And I do think DOGE is in my opinion, it's a very, very powerful concept. And now you're dealing with 20% of the budget that isn't, that is discretionary. But I do think that sets a tone for everything else. And I do think there's a certain sense in which you worry about the pennies and the pounds take care of themselves. But the best way, obviously, so not only is it reducing wasteful government spending, but it's also a big focus on growth, right? It is encouraging capital formation, encouraging capital investments so that you can grow your way, you can grow the numerator, so that the deficits are not necessarily, the denominator rather, so the deficits are not really as big a deal. And to me, that's where I would focus more than anything, is economic growth, and then also, just stop doing dumb things.
Jason, quickly here.
Which is not always easy.
Yeah. Jason, quickly here on the Mag 7, are you still long our tech vision?
Listen, I think it's really difficult. The market's not cheap, but it's really difficult to fade these companies because they have the cash flow with which to continue to invest in artificial intelligence. And I would say your average CEO of a company in the United States is more at risk of being fired by not spending enough on these new technologies than spending too much, at least now. And I think, and most of the companies have this ability they have the cash flows to do that. So there's not a big risk to it. At a certain point, there's going to have to be some sort of proof of concept that these investments are actually resulting in productivity. But I think you have some time before those expectations get too high.
Jason Trennert, one of my heroes, William Priest, was in the studio yesterday. Yeah. Definitive book on free cash flow and shareholder yield. What is the quality of the Mag 7 free cash flow?
Well, it is quite good. One of the things, though, that is changing that I think people have to kind of keep in mind is that these are no longer really capital light industries because of their investments in AI, right? So if you look at, let's say, capital expenditures as a percentage of sales, the Mag 7 is actually more capital intensive than, let's say, the energy sector, right? So that is a difference. And so the good news is these companies are throwing off tons of cash. That means that they can make their own luck as far as stock prices are concerned, generally speaking. They can buy back stock or increase dividends or what have you. But a lot of the cash flow now is being directed towards capital investments, and so that means that sooner or later those capital investments are going to have to bear fruit, or they're going to have to retrench, and there'll be a repricing of those stocks. So the good news is they have the money. The bad news is eventually the clock will be ticking to see whether those were good investments or bad investments.
Jason, can you talk to us just broadly about these markets as we head into 2025? It feels like sentiment levels are really stretched here. I mean, valuations are one thing. Maybe, the market can earn its way into the valuation, but boy, sentiment seems pretty stretched here. Is that a concern for you?
It is. It's definitely a concern. I mean, and I think financial conditions, in my opinion, it's ironic because financial conditions, if you're rich, are quite easy. Financial conditions, if you're not rich, are quite tight. And this is one of the issues, right? So you have some guy buying a banana taped to a wall for $6.5 million, and then there's other folks that can't get a mortgage, right? So, but in my opinion, sentiment is getting kind of frothy out there. There is a lot of excitement about things like Doge. There's a lot of excitement about deregulation. All of those, I think, are worthwhile. The thing we're watching very closely to determine when to get more concerned about equities really is the 10-year Treasury yield. We've seen since this bull market started in October of 2022, there have been 3 major corrections since then in the bull market. 2 of them were associated with 10-year Treasury yields above 4.5. The third was associated with an end to the yen carry trade in August. So in our opinion, 4.5 to 5% is a little bit of the red line for risk on. And if yields rise to 4.5 to 5, we're going to start to lighten up a little bit. Not necessarily get bearish, but maybe get a little bit more defensive and raise a little bit more cash.
Jason, what do you need to hear from your Federal Reserve Chairman this afternoon?
Well, listen, I would like to hear that they are very aware that there is not an insignificant chance of another wave of inflation. I know that kind of ruins the party a bit, but I also believe that to be true. And 10-year Treasury yields are up 70 basis points since the Fed first eased. Mortgage rates are up since the Fed first eased. And there is a fair amount of historical precedent. Don Ritzmiller, our chief economist, did some great work on waves of inflation, and what he found was that once you have one wave of inflation over 6%, the chances of getting another wave are about 9 and 10. And he looked at about 24 countries over 100 years.
Right.
Part of that is because wages, there are pent-up demand for wages, and you're seeing that with let's say Boeing machinists getting 38% over 4 years, longshoremen getting 62% over 6 years. Part of that is to make up for the fact that their standard of living declined when inflation rose the first time. So once the toothpaste is out of the tube on inflation, it's kind of hard. It's harder to get it back in than you think.
If we have an inflation, old Georgetown microeconomics, there's an ambiguity, Jason Trennert, and that will sustain nominal GDP. So which way does it cut if we have sustained or even a bit higher inflation? Does that help General Mills, Colgate-Palmolive, and NVIDIA?
Well, it helps profits, right? So because profits are nominal, revenues are nominal. It tends to hurt multiples, though, right? At least before QE, higher inflation would lead to higher long-term interest rates, which would lead to lower multiples. That relationship has weakened meaningfully since we started using the balance sheet like some sort of plaything. And with a $7 trillion balance sheet, that relationship is a little bit weaker. Having said that, higher long-term interest rates tend to hurt the multiple. So, Tom, you're right. It helps profits, and equities are not a bad hedge against higher inflation. They're a better hedge than fixed income, but it's not like it's free, right? It comes with a cost, and that's the willingness of people to pay up for those earnings.
Jason, some folks are suggesting that as we think about some of the potentially inflationary pressures from President-elect Donald Trump's economic policies that we know of to date, that deportations might be more inflationary than, say, tariffs. A, do you believe that? And B, how would you advise, I guess, the president on that?
Yeah, no, I actually think that's right. We've spent a lot of time on some of these issues. I have to say, remember President Trump raised tariffs in his first term. When you look at the data carefully, what you find is really the tariffs went up meaningfully, really only against one country, and that was China. There were other countries like South Korea and Taiwan where President Trump actually cut tariffs during his administration. And I would say this time around, China still is in the crosshairs. I agree with your assessment, though, about let's say mass deportations. And Peterson Institute came out with a study. Doesn't mean it's correct, but they found that the relationship between inflation and mass deportations is higher than it would be for what's being forecasted for tariffs. And so, which is to say, let's say let's just pick a number just at random. We deport 1 million people here that have had some run-in with the law or here illegally.
Right.
I don't think that would have a big impact on inflation. If you start deporting 8, 9, 10 million people, that's going to have an impact on the labor markets, right? And then we have to make a decision as a country whether that cost is worth it. But I am very sympathetic to this idea that that's maybe part of the economic plan. It's not part of the economic plan, but it's part of the policy mix that is, for inflation at least, is something we have to keep an eye on.
Jason, got to leave it there. Jason Trennert, thank you so much. With Strategas, a lengthy conversation this morning on his American stock market and economic experiment.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
The Daily Look at the front page is the Lisa Mateo Show. Lisa, what do you got?
Okay, more protests surrounding the Paramount and Skydance merger. Now you have the Center for American Rights. It's filed a petition with the FCC. They're citing potential foreign influence and bias. What am I talking about? Okay, so this said that an investment in Skydance by the Chinese company Tencent, it raises questions about foreign influence over the U.S. media. And then they're saying that Paramount CBS News division has a track record of ideological bias and also lacks diversity in its hiring practice. But I don't know, is this merger going to be approved by the FCC? I mean, they're saying most of it, likely, it is.
In my personal opinion, having followed the media industry for 35 years, zero risk here of it not being. I mean, Skydance is just...
Is it a real estate play? Like, they show the Paramount Studios.
It is a great lot.
That's like, if they bulldoze it, it's worth a lot of money.
It
right?
is. I mean, there's that as well. We saw that with the Fox lot when Disney bought 21st Century Fox. A lot of value allocated to that. But it's just, it's a... Skydance looking to get into the media business. It's the son of Larry
Ellison.
Ellison.
Rich
looking
guys
to get
wanted to make movies.
Exactly. And
it's still that way.
And it's Sherry Redstone looking to get out as quickly as she possibly can to anybody that'll write a check. And that's how this deal came about.
Did it change the industry? Did it change streaming? Did it change Warner Brothers Discovery's discussions?
No, this new company, this new Paramount owned by Skydance is now going to have to think about, okay, now what do I do? I probably can't stand alone. I probably need to talk to Warner Brothers Discovery. I probably need to talk to some other media companies about getting bigger.
Tim Cook out yesterday with the lead actress, I think her name is Ferguson, excuse me, I'm so sorry I don't know it. The show Silo I watch on Apple. They extended it for season 3.
There you go.
Season 4, and they have the lead actress in Tim Cook. I think they're sort of on the set of Silo, and she's thanking him for the gazillions of dollars Apple spent on this show. And he said he's addicted to it. Okay, I mean, it really helps if the head of Skydance is addicted to your product, right?
Exactly. Apple's got the money. And
who greenlit the red one with the rock?
Yeah, I don't know. I think that's Lisa Mateo.
Still trying to get through that one. Okay, holiday party season, right? So how do you behave?
Please tell us.
The Wall Street Journal has a whole detailed, a few examples of what you should and should not do. So they're saying a work party is another day from work. You're not kind of off duty, so just be careful. Yes, the drinking, the dancing, the flirting, and you can get fired for some of that because it is a work function. What you wear, expect the usual office dress code if slightly less formal, bow ties included, okay? And it says heed the hierarchy. Make a point to acknowledge, perhaps thank the boss. So if you're going around, say, hey, thanks for, for the great year. Mingle. Here's the thing, mingling, right? Don't linger and don't hover.
I can't stand in the corner next to the bar?
No, and you can't be on your phone. That's the other thing. You can't isolate yourself.
Yeah, I'm not very good at that.
You have to mingle.
Okay.
No, you're good at that.
You can dance.
You can
but don't get carried away, Tom, okay?
No.
Can I say something about this? The guy that wrote the article at the Wall Street Journal on Party Times is one of the smartest guys I ever met. Paul Podolsky was, I think, at Fleet. My mind's, this is like back when they were throwing tea into the harbor. But Paul Podolsky was there with two other guys, Greg Anderson, at the bank, and they wrote a morning memo that was so smart, you stopped at 7:02 a.m. when they released that memo. He was legendary for writing cross-asset, smart memos. Paul Podolsky at K Capital, good morning. And he's a party monster.
Exactly.
Have you ever gone to three parties in one evening?
No, he has.
That's like work. You take the beverage. They all want to give me a martini, and you touch it to your lips.
Oh, you pretend.
You pretend. Yeah, you can't get through the evening if you don't. I wouldn't get out of the first party, but it's part. It's very difficult. Next, what do you got?
Oh gosh. Okay, so we did that. So we were talking yesterday about the malls. You were asking me, how are the malls? Are they crowded? Are they not crowded? So apparently, this from Women's Wear Daily. They spoke with the head person over at Simon Property. They own a lot of the malls. And they said how their recent traffic figures shows that they're starting to see growth. How? Basically, what they're doing is they're turning malls into more like a community. So they're adding luxury apartments, hotels, they're adding gyms like a Lifetime Fitness, they're adding grocery offerings, more food and beverage, more restaurants because they want more people to go. And also they said, it's all about the quote experience. So family and kid play areas, mommy and me yoga.
Is there a 17-year-old play area? Remember your parents screaming at you, and you're not going to the mall. Lisa, you were there. How many days a week were you hanging out at the mall?
That was the place to be. That was the place to be, the mall.
Is it still the place to be?
But it's a lot of the kids, like the teens, the parents just come, drop them off. And enjoy the day. Boom. Yes, enjoy the day, enjoy the Apple Pay, and have fun at it. But it's about becoming a community, and that's how they're keeping the malls alive.
The interview we had yesterday with, I'm going to make it up, Bert Crouch, was it? At Invesco was brilliant.
Yep.
He was brilliant.
Yep.
He just said the gloom is not as bad as people think.
Right.
Yeah, no.
You got one more for us?
Last one. Oh, yesterday we told you about the Amazon return to work 5 days a week policy that starts next month. Now AT&T, they're saying their policy kicks in the new year, 5 days a week. They've been doing the hybrid schedule for about a year. So the thing is that now there's talk. You have Reddit users on the AT&T subreddit. They're saying that, well, you know what? There's not going to be enough room for all these workers to come back. The same issue that Amazon is having is that they're bringing all these people back, and there might not be enough room. So that's one of the issues there for Amazon. But a lot of people are saying it's even harder to find a job that's remote.
AT&T is a huge employer in the state of New Jersey. That'll be interesting to see how that plays out.
Interesting. Yeah. I have no idea how this plays out. It's one of the great mysteries for me. Lisa Mateo, thank you so much. The newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.